In a previous video, I conducted an intriguing experiment when I asked my viewers to suggest which FTSE 100 company they thought could beat the market over the course of the next 12 months. I then put £5,000 of real money on the line and I bought the 10 most popular choices my viewers came up with. It was an experiment to see if our collective wisdom and insight could beat the market over the course of a year. And here are the 10 most popular companies my viewers chose. Can this Dream Team portfolio defy the odds and beat the market? This is not investment advice and is purely for entertainment purposes. Please do your own research. To set up the new portfolio, I opened an account with Freetrade, and in June 2022 I put £500 into each of the 10 most popular FTSE 100 companies suggested. Let's see how we've done over the last year. I'll start with the lowest performer all the way to the highest. In 10th place is Persimmon, and it's had a tough 12 months. Even with dividends reinvested, we're still down over 40%. Rising interest rates have made homes less affordable, therefore reducing demand for Persimmon homes. Persimmon have cut their dividends once already this year, and in terms of capitalisation they are 97th in the FTSE 100, which means they could be in danger of relegation to the FTSE 250. If this happens, some institutions which track the FTSE 100 may be forced to sell the shares in their portfolio, thereby putting further downward pressure on the share price. There has, however, been some positive news on UK inflation, which has raised the share price recently. At number 9 is National Grid, and they are slightly down since purchase. The shares are a big favourite with investors who want a steady income. Over the last 5 years, the share price has beaten the FTSE 100 by nearly 30%. However, National Grid is in a highly regulated industry, and the shift away from gas to concentrate on its core business will be expensive. At number 8 is Aviva, showing a gain in value of 1.8%. Aviva currently pays a huge dividend of around 8%, which is way above the FTSE 100 average of 3.7%. The dividend is covered 1.6 times earnings, which is okay but not ideal, as a value of 2 would provide ultimate peace of mind for investors. A dividend cover of less than 1 would mean that a company can't actually afford to pay the dividend and would effectively be borrowing it to pay shareholders. It's always worth looking at the dividend cover before you consider buying a share. Over the long term, Aviva could deliver strong capital gains as well as big dividends because of the market it operates in. Protection, pensions, annuities and lifetime care should all increase as the UK's elderly population grows. At number 7 is Legal & General, up in value by 2.5%. The dividend is 8.6% and is covered 1.7 times by earnings, so slightly better than Aviva on both counts. Cash generation is expected to rise and the company has a strong balance sheet, but over the long term investors should probably expect to benefit more from dividends than capital growth. Over the last 5 years, the share price has fallen by nearly 12%. At number 6 is Barclays, showing an overall gain of 4.6%. The share price has been rather volatile this year, but the dividend is good at over 5%. In times of high interest rates, banks tend to do better, but when interest rates rise too quickly, there is a danger that rising bad debts and loan losses in the future could impact profits. And number 5 is Lloyds Banking Group, giving us a gain of 9.3% over the last year. Lloyds currently pays a dividend of 5.8%, but as mentioned already, there are significant risks in the banking sector. A rise in loan impairments is a big possibility as companies and individuals struggle to make ends meet. As with Barclays, the Bank of England's rate rises have boosted the profits banks make on their lending activities, but they also threaten to turbocharge the quantity of bad loans on their books. At number 4 is SSE, showing a gain of 13.3%. It has been a strong few months for SSE shares, but the company recently cut its dividend from 5.4% to 3.4%. As a pure income stock, this will make it less attractive, but the company is using the cash to invest in renewable energy. SSE's biggest renewable energy project is at Dogger Bank off the northeast coast of England. By 2026, it will be home to the world's largest offshore wind farm. At number 3 is Unilever, showing a gain of 16.2%. Unilever has had a good track record of dividend growth and is usually very resilient in tough times due to its strong brand loyalty. However, in the last 5 years, the share price is still down. Perhaps their new CEO will turn things around. Only time will tell. At number 2 is BAE Systems, up 24%. With the geopolitical world still going through turbulent times, many companies continue to boost their defence spending, and BAE Systems will of course benefit from this. And at number 1 is Rolls-Royce, up an incredible 65.9% since we bought it a year ago. The company has had some tough times in recent years, but with air travel bouncing back and a new CEO at the helm, things are looking much better indeed for the future. So how has our portfolio performed over the last year? The total invested was £5,031 and it's finished up £482, which is a gain of 9.6%. I also bought a FTSE 100 ETF at exactly the same time to act as a benchmark for our viewers' portfolio. Any dividends from this ETF were also reinvested and the value is up 8%. So yes, we have beaten the market in our 1-year experiment. The ETF I chose has the ticker code ISF and the value has increased £40 at the time of this video. This graph summarises the journey from the start, with Persimmon letting the side down somewhat. National Grid is also down, but all the others have increased in value. Lloyds, SSE, Unilever, BAE Systems and Rolls-Royce have all performed better than the FTSE 100 ETF, and the average gain in our portfolio is 9.6%, which is higher than the FTSE 100 of 8.0%. Just a word of caution here that picking individual shares carries significantly more risk than investing in an index tracking ETF. In my own portfolio, as well as individual shares, I have 3 different exchange-traded funds, giving me exposure to thousands of companies across the globe. Thanks to everyone who suggested shares for the viewer's portfolio. It was just a bit of fun, and the portfolio not only made a small profit of £482, but we also beat the market over the course of a year, which was the initial aim. I'll shortly be selling the entire portfolio and I plan to drip feed the funds into my main portfolio, and if you want to see the latest performance of that, then click this video here.